Welcome to FXpert Trading, where I use time cycles, median lines, and other technical analysis to identify trade setups in the US stock markets as well as the FX markets. If you like the information contained within this video, be sure to subscribe for more. This update is for the S&P. We are currently on the futures daily chart. In my last video about 2 weeks ago, I made it somewhere around, I think on the 25th maybe, or the 24th, I mentioned I would not be going short, looking for the expected trough coming in around Wednesday. The 31st came in right on time. This was more difficult to trade than the prior trough for a couple of reasons. If we take a look at the 3 hour and we put on the FLD, I've mentioned several times how I like to use this to help confirm trough bottoms. This FLD is set to 8. The cross came during market hours when I am asleep. As I've mentioned before, I live in Asia. However, using the SPX chart, as I had mentioned in that video, I would be looking for a retest of this upper warning line that we had broken out of, or a retest of the all-time high that we had recently broken out of. If we take a look at that on the daily chart, we can see the median line set we broke out of and retested is a modified shift median line using these 3 pivots. We broke out and retested exactly where and when I expected it. Also with the expectation it may have gone down to retest the all-time high that we broke out of from January. Despite the way we troughed, I still managed to get in. I had set positions. Again, as I mentioned in that last video, I was going to be going heavier with the spreads than the calls. I actually did not take any calls. I only did call spreads. I set a fill order for roughly this area, another one here. This one got filled when we gapped up a little bit from the close from the prior day. We still didn't have confirmation of the trough, but I put on another one in the event that the trough had come in, especially now that this bar was a day later than expected. We're back on the futures chart with the trough cycles here. That was this day. Aside from those 2 positions, I did not put any additional positions on, and I had actually closed them both on Monday at the open because, as I had mentioned in the prior video, there are a number of different resistance points that we're moving towards. We've actually gone through a couple of them, but we are also late now, or we're about halfway through, but we're beginning to get into the later end of this longer term blue cycle where I expect us to turn down, and I think there might be a fair bit of downside to come. I'd like to ignore these 2 possibilities you see here for now. There actually are other possibilities. There's no clear evidence for either of those at this time. But what's important for trading purposes is we are now coming towards the end of this lower time frame orange cycle. There's no reason to short this based on this orange cycle. As you can see from the prior orange cycle, it can be very difficult to time it correctly, and you have to be able to get in and out at just the right time before the market completely destroys you. Considering that momentum is still strong to the upside, it doesn't make sense to open short-term shorts. With that said, I have started to layer in some longer-term shorts with expirations going out into mid-March. All of those positions that I've opened are spreads with long-term expirations. That way, if the market does continue higher, they don't get totally destroyed, and the market does not need to correct in a huge way for those to still become profitable. They are also not full positions. They are smaller positions. Right now, I have about a half of a position on in total, and I entered those trades using the SPX chart. I have 3 different types of resistance that I'm looking at as we move forward, one of which we've already hit, we've actually broken through, and it's the one that I used to start to slowly enter into those longer term spreads. Beginning here, using these pivots, you can see this has been a pretty good median line set, with the exception of breaking below and then coming back into it and now breaking towards the upside up here. And we do have a sliding parallel this orange line is parallel to the upper warning line of this median line set. The first spread that I put on triggered right here. The second one triggered right here. And now I have a third one set for up here, which is also based on this median line of the larger set that we have here. Now, you can't give this too much consideration, but the last couple of times we've hit this median line, we've sold off pretty hard. That would be prior to the final pivot coming in, but you can see this frequency is already, well, a frequency of interest. We came back up and retested it, sold off hard. Came back, tested it again, sold off even harder. Now, once we potentially satisfy this again, I do think there is a chance that going into the upcoming cycle troughs, we'll work our way back down to this zone, if not even further down. We are now on the SPY daily chart, and as you can see, I still have an old median line set on here for the correction beginning from January all the way through October. And you can see this median line set, the corrective move worked out pretty well as we came straight to the median line, back up to the half line, back down to the median line, and now we are moving up again. Now, this does not always work out well, but sometimes the upper warning line of what I'll consider a corrective median line set continues to act as resistance, or it continues to show that this median line set is relevant. We are now moving pretty close to that again, inside of these parallel green lines, which is just connecting, they're just trend lines connecting low to low here. And then I copied or cloned that and connected it to these highs as well here. We are now testing the upper range of that right now. We may, in my opinion, overthrow it, perhaps come up, touch this upper warning line here before we finally sell off. So using those potential resistance areas as long-term entries for short spreads, how can we trade this in the shorter term? Well, you can't short this yet in the shorter term. That's why all of the spreads I've opened up have a longer term expiration to allow this time cycle to play out. And in the event we do move up a lot higher, I will wait for this trough or the next trough, and depending on how high up we go and what the pullback starts to look like, we may end up closing those for a loss. But again, that is why that is a small position. There's a lot of time on them, and they are spreads rather than just puts. For the short term, we're looking for another potential trough around Wednesday. Now, that doesn't mean it will come in exactly on Wednesday like it did in the last cycle. As you can see, sometimes they are shorter, and other times they are longer. This one is on time. This one was difficult to read. This one may have been longer here. So until the cycles truly start to break, shorting them on the short term is difficult. You have to stick with the momentum and continue to play to the upside. So I will actually be looking for that in this trough time zone. How will I look to confirm that trough? Exactly as I did here, here, and here. We are now on the 3-hour chart with the 8 FLD on. I will be looking for a clear cross below, followed by a cross back above, somewhere around the anticipated time of the trough. An additional way to do that is to move to the 1-hour chart and look for daily cycles that are creating lower highs and lower lows, and then for a break of that where we start to put in a higher trough. You don't necessarily have to wait for a higher high from the prior cycle, but as soon as you put in a higher trough, that is likely a good time to go long, as the longer term orange cycle bottom may be in. We're back on the daily chart. Considering my longer term, or well, really intermediate term bearish thesis, I again will probably not be buying calls unless if I can get them very close to what I consider to be the bottom. Otherwise, the safer play is going to be call spreads, and just like I did during the last cycle, because I'm expecting this to roll over at some point in the near future, I'm going to look to close them very soon. Normally, I like to keep them open for 5 or 6 days, sometimes 7 or 8 days, depending on where we are in the larger cycles. This last one I closed on Monday after opening them on Wednesday and Thursday, which is 5 days, but only 3 trading days. Now, as I've mentioned, I'm expecting this to roll over. So what will that look like, and when will I start to open calls? Whenever we put in this trough up here, let's just move this here. Let's pretend the trough comes in somewhere around here. Well, as soon as we take out that low, as soon as we get this next trough, this trough here, whenever we take out that low, that will tell us that the peak for this blue cycle is likely in, and we should have downside the remainder of the way. Once that happens, then I will start to open puts, not just the put spreads. The reason for being so patient on that, again, is, well, with spreads, you can open them pretty close to the money. They're actually really cheap right now. Mine are in the low to mid 490s, and they cost, one was about 115 on a 5-wide spread. The other one was 150 on a 5-wide spread with long expirations. So should the market continue to move higher, they should be okay, considering we'll still get what should be a fair pullback. It should be a larger pullback than this prior pullback. Whereas if the market continued higher and then only got a smaller pullback, those puts are not going to be profitable. Now, if you watch other channels on YouTube, everybody is expecting a pullback here. Everybody is expecting the market to roll over and for there to be a pretty sizable pullback. And there are a number of good reasons for that. However, usually when everybody is thinking one thing, the market likes to do the opposite. And that is why I think there is a strong possibility we get a nice rip down in just a couple days, maybe 2, maybe 3 days into this trough. And then we might make another high. So it tricks everyone into going short because it might be a quick, violent move down that everybody is expecting. Then we might pop back up again just to take out the high really quickly before we finally roll over. It may not happen, but it's just something to keep an eye out for, especially if this trough is higher than this trough. Then there is no reason to believe yet that the high is definitely in. So again, you can't really consider the high being in until after we get this trough and that trough gets taken out, unless this trough takes out this trough over here. But I don't think that's going to happen by Wednesday or Thursday if it comes in late. So where do I expect this trough to come in? We're on the SPY daily chart now. We have held this median line set. I know it's kind of difficult to see because we have this buying channel right here as well. And the lower warning line lines up perfectly with this channel. And this is also where we found that bottom on Wednesday, January 31st. I think it's possible we come down, we fill this gap here. This may hold. I wouldn't necessarily expect that, but I think the buying channel will hold. And that's why perhaps if this comes in early, maybe it comes in on Tuesday rather than the expected Wednesday. Again, that's just an average. We could fill the gap, test the lower warning line and the lower channel here in this pink. We might pop back up, then maybe we hit this upper warning line. This is that larger corrective median line set from the pre-COVID high, COVID low to January that I showed earlier in the video. We may test that, pop back up, hit the upper warning line, and then perhaps the selling will begin. And as I mentioned in the last video, I have some levels on here. There's no reason to believe any of this is what's going to happen. This is just a thought as to what could happen. We come back into the lower end of this buying channel, and then this is for a trend line going back here. We may retest that, and that would align with what I explained in my last video with this potentially, as I have a larger cycle bottom coming out in May. It does not need to play out either pattern that I have on here. It could do anything. We can't really make more accurate predictions until we see where these troughs come in and see what lows they do or don't take out before we can really have a good idea of what may or may not happen for this longer term cycle trough expected towards the end of May. Finally, I want to take a look at one more chart. We have the SPX on the lower pane, and we have the percentage of stocks above their 5-day moving average in the upper pane. And what I'm about to show you has only happened one other time in the last 2 years. I don't know when it happened prior to that, but just one other time in the last 2 years. So We don't have all of the information I'm going to discuss on here, but if you were to look at all of my 2-week cycles, at some point during that cycle, the percentage of stocks above their 5-day moving average at least touched 75. In the current 2-week cycle, so if we look, this is the trough from January 31st. Usually within the first few days, we bounce back up all the way to 75%. We did not get that initially. That is fine. If it does not happen within the first few days, usually towards the end of the cycle, it comes up to 75. We are nearing the end of this 2-week cycle already. As I mentioned, the bottom will come in, or the expected trough is Wednesday. Now, it could peak on Wednesday and trough on Thursday. So there is still time for this to play out. But as of now, we have not reached 75% of stocks above their 5-day moving average. When was the one other time in the last 2 years this occurred? If you watched my last video, you will know I have been comparing this fractal to the fractal, which peaked on July 27th. And this is the last 2-week cycle. Let's take a look. The trough came in on July 20th. It was already high when it troughed, but it was not at 75. And this is a little unusual as well, for the trough to come in and for the percentage of stocks above their 5-day moving average to be this high. But it went sideways and then down by the time it peaked. By the time it peaked, it did not, from the trough to the peak, it did not reach 75%. In fact, it was moving down the entire time. What happened after that? Similar to what I'm expecting now, where we have a sell-off followed by another sell-off after we get a bounce. This was about halfway, a little more than halfway through the second to last blue cycle in my longer term cycle. We are currently about halfway through the second to last blue cycle in my longer term cycle, which goes out until May, which I hinted at just a moment ago. If we look at this cycle, we have our trough, and again, so far we have not achieved 75. We've pretty much ultimately kind of gone sideways, well, sideways to up, as the market has continued higher. And now if we do roll over and stocks do not reach 75% above the 5-day moving average, this may be another indication that perhaps the top is in, and perhaps we will not trough and then make one more peak. It's just something to be watching out for. And going forward, I will show you how else I use this for the shorter term orange cycles. As always, thank you for watching this video, and be sure to subscribe for more.